Hi guys. Today we will analyze Comcast stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. The stock's overall performance in the market is below average. Also, recent evolutions are not positive. The short-term trend is negative, the long-term trend is negative. There should be more interesting stocks out there. Support levels are around $45 and $41. The next support level is around $38. Resistance levels are around $47 and $52. The next resistance level is around $55. In the last month the stock has been trading between $44.30 and $47.60 range. It is currently trading in the middle of this range. It may be a good idea to wait for a pullback before considering an entry. The stock has an average volume of 23 million. This is a good sign, as it is always nice to have a liquid stock. The stock has been in downward trend since September 2021. Be careful. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model. Discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 8% per year, for last 5 years. We see that the average profit margin of the stock has been around 15% per year, for last 5 years. Also, we see that the average free cash flow to net income rate of the stock has been around 110% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for Comcast Company: bad, average, and good. First scenario. Comcast will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be low, 4%. Future profit margin would be low, 10%. Future free cash flow to net income rate would be low, 60%. In this case, the fair value of the stock today would be $43. Second scenario. Comcast will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 5%. Future profit margin would be average, 11%. Future free cash flow to net income rate would be average, 70%. In this case, the fair value of the stock today would be $57. Third scenario. Comcast will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 6%. Future profit margin would be high, 12%. Future free cash flow to net income rate would be high, 80%. In this case, the fair value of the stock today would be $73. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 3.04. Minimum rate of return. I will use 12%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For Comcast, analysts forecast growth rate around 6% per year in next 5 years, and future P/E around 14. Again, I will use 3 different scenarios for Comcast Company: bad, average, and good. First scenario. Comcast will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be low, 4%. Future P/E would be low, 14. In this case, the fair value of the stock today would be $22. Second scenario. Comcast will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 5%. Future PE would be average, 17. In this case, the fair value of the stock today would be $29. Third scenario. Comcast will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 6%. Future PE would be high, 20. In this case, the fair value of the stock today would be $37. As you can see, today the stock is overvalued, $46, even if we expect the company's high performance in future. The fundamentals are decent. And the stock looks fairly priced at $46. But keep in mind that the stock has been in downward trend since September 2021, so, it may drop lower before it goes up. I like the stock at these levels. But I will buy the stock when the stock shows signs of reversal. Company's strengths. Comcast is a leading cable and telecommunications company in the U.S., providing television, high-speed internet and telephone services over its networks. The company owns NBC-Universal, a media conglomerate that includes cable and broadcast channels, local television stations, a movie studio, and theme parks. The company's cable division continues to provide vital connectivity for its large subscriber base, and as economies reopen, the theme park, advertising, and theatrical businesses are also rebounding smartly. The company has focused on innovation, particularly with regard to Comcast's top strategic priority, broadband service, as it works to improve speed, range, and connectivity. Comcast is a leader in the broadband speed race. Through the Sky acquisition, the company is also expanding into new markets in the UK and Europe. Comcast is sticking with its mobile virtual network operator plan and expanding its partnership with Verizon, offering new 5G wireless service. The company's solid balance sheet and cash flows remain key differentiating assets for this industry leader. Comcast's return on assets of 5% is amongst the best of the industry. Its profit margin of 12% is amongst the best of the industry. In coming 5 years, Comcast will show a medium growth in earnings per share. The EPS will grow by 8% on average per year. The revenue is expected to grow by 6 to 8% on average over the next 5 years. Risks. Comcast continues to lose video subscribers while gaining high-speed internet subscribers. Management has warned of elevated production costs related to the return of delayed sporting events and other programming. Programming costs are Comcast's largest single expense item, and faster growth in expenses than revenue would erode the company's profitability. The company is seeing increased competition and cross-selling from rejuvenated providers, such as the telecoms and their satellite broadcast allies. Netflix has become a deadly threat through its aggregation of content and viewers. Increasing marketing and promotional costs in this highly competitive environment are also likely to hurt margins. Comcast's acquisition of Sky carries significant integration risk. Sky is focused on Europe and thus operates in a considerably different market environment. Comcast is less able to pay its short-term debt than its industry peers. The company also required more debt to finance its operations than its industry peers. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.